Good morning, everybody. Let's talk accounting. All right. So, where we left off in class, we were working on a problem that was similar to problem 12 on your homework. Um, and I just want to thank Jakaya for suggesting this problem, which you can find on pages 52 and 53 of your workbook for Lucky Gold Restaurants Incorporated. I have gone ahead and I have transferred the balance sheet and the income statement over here, and I had started the basic outline of the statement of cash flows that's required to be done. Now I'm going to do this all in Excel, right? And what we're going to do is we're going to start off. All right, let me just move that over. We're going to start off with uh, starting our cash flow statement, right? And when we're doing our cash flow statement, the first thing that we would do is we start with our net income. All right, cash flow from operating activities, just like we've done in class before. If you have done what I did and set this all up, you can just do things like this, right? And it automatically transfers over. Um, I will show you a few things. You'll notice that whenever there was math done, I didn't just copy the book's numbers, I did them myself. Um, and that's a good way to make sure that your numbers that you put in are the same as the ones that were in the book. It's a nice little check. Wait, why is my 114, 427 different than what the book said it was supposed to be? Okay, we're good. It's the same. After net income, what's the next thing that we do? Right? So we got to sit there and go, well, we need to start making some adjustments, right? For non-cash items. And you'll notice here that I gave us plenty of space, right? And you can delete cells and insert cells as you need. So we'll see if we got enough space. We're going to do some adjustment for some non-cash items, right? And I like to start off with, and I know this is not a shock, depreciation expense, right? So when we do depreciation expense, we look over and where is depreciation expense? Well, that's going to be over in the income statement. That's where we're going to add it from, right? And then we had some other things, right? Non-cash items. Well, we had two gains. If we take a look at our thing, right? It told us that we gained some stuff, and we can see it right here too, that we gained on long-term investments and on equipment, right? And instead of typing it myself, I'm just going to go ahead and do that, right? Indent it so that way we see that everything's on the same same mathematical sphere, right? And then we have gain on sale, right? And I'm going to put a negative right there because we are taking that money off, right? So, and we're going to do the same thing for this gain on sale. And you can see how it automatically puts it in to the brackets, right? Next, we're going to take a look at any more non-cash items. I don't see any, right? So now we can go ahead and we can do changes in current assets and current liabilities, right? And we had a few, did we not? when we take a look, and now because it's current assets and current liabilities, we got to take a look over here on our balance sheet, right? And what I'm seeing here is an increase in accounts receivable, right? And that increase looks like it to be about $4,000, right? And because it increased, we're going to subtract it because an increase in accounts receivable means that we haven't gotten the money yet, right? But I need to do some basic math. Right, just to verify. And I also set it up this way. So if you have also an increase and you do all this stuff, if you change these numbers, it will automatically change what you had for your increase in accounts receivable. So next, what else did we have? We had increase in accounts receivable, and it looks like we had an increase in food and beverage inventory, right? Now, what's really nice about this is that food and beverage inventory happens to be right below accounts receivable. So I could redo the same formula I did before, or I could just drag it down. Because when it increases, we have to subtract it, right? Because money went out. And if you want to verify that it did the right numbers, it'll show you right there that it was the current year minus the previous year. That's the change, which happened to be a positive. Okay. Next, we're going to take a look, and we're done with current assets. We're going to take a look at current liabilities. And we can see that there was an increase in accounts payable, right? Now, with accounts payable, an increase means what? That no money went out, right? So we need to sit there and add that back in. So we're going to sit there and go equals this minus that, right, for the change. And that happens to be $4,000. Is there any other changes in current liabilities? Well, no. All right. This concludes the portion that would be all the operating activities. So we can go ahead and we can delete these rows, these cells. We're just going to shift that up, right? And it's just going to automatically move it right on up. I'm going to go ahead and put a line underneath this one, which doesn't really matter. Maybe I can put a thicker one in there. There we go. Right, it just shows that some math has been done. And what we're going to do is we're going to just equal sum, and we're going to highlight all those things because the positives get added in, the negatives get taken out, and we're going to come up with a net cash provided or used, right? If it's used, it'd be in brackets, by operating activities. 29,327. Okay? Now, give yourself a space in between. I really encourage you to set up your statement of cash flows the same way I have. All right? Now, coming up, we're dealing with the part that tripped us up a little bit in class. Sale of equipment. Right? Because if we take a look over here at the equipment, right, it increased, but we had a purchase of $30,000, right? So I'm going to show you how to use T accounts in order to figure out how much you sold the equipment for. Okay? Or how much the equipment was valued. So if you remember, we had to do equipment and we had to take out the depreciation, right? So a T account for equipment, the normal balance is on the debit side. So we're going to start with the beginning balance. Beginning balance was 76,000. We know what the closing balance is. That's 89, right? And we also know that we purchased some equipment, right? So how do we figure out the book value of what was sold? Well, what we're going to do is we're going to add these two items, right? And we're going to subtract out the closing balance. Okay, so it says 17,000. So do we put 17,000 right here? No. We have to figure out how much depreciation we had to take off our books in order for it to be cleared out, right? Because we depreciated that equipment over the years. So let's go down to depreciation, right? And we're going to start with our beginning balance, right? And I'm going to go ahead and reverse the negatives on these, because in the T account, they wouldn't show up as negative anyways. 2022, we had a depreciation of 8,200. That's in your income statement, right? And now we need to figure out the depreciation that was written off of our books when we sold this equipment. So we're going to do the same thing as we did with the equipment. We're going to add these two up and subtract out the closing balance, $4,000. Now, is that, if we take equals this minus that, is that the correct amount? No, because we had a gain on sale of equipment. We need to add in that gain on sale of equipment. That 13,000 that you saw, that is the current book value of that equipment. That's the purchase price minus the depreciation. That was what it was. But we had a gain on the sale, and that is 15,500 altogether. So we can just go ahead, equals, and do that. Right? But this one here had two sales. If you sit there and take a look, right? We have long-term investment purchases of 10,500. But long-term investment went down. So it's clear that we sold some of our long-term investments. So we're going to go ahead, sale of long-term investment, right? And I'm just going to go ahead and move this over here. And we're going to start the same way we did with equipment, right? We're going to start with the beginning balance, which was 2021, right? We're going to do the closing balance, and we're going to do the purchases. And the purchases, the book told us, was 10,500. Right? To figure out how much the sales price is, that's right, we're going to do this plus this minus that. Because when we add up these and we subtract that, our closing balance will be that. It's just some basic algebra going on. Right? Now, was there a gain on our sale of investment? Yeah, it's right there in our income statement, right? It's right there. So we're going to take equals this plus that, and we're going to have our investment sales price. Now, if you set everything up the same way I did, you should automatically get some of these numbers too if these have changed, right? What's next? Well, we had some cash flow from investing, and I mentioned that we purchased some stuff, right? So we got to take care of that purchase of equipment, right? And I went ahead and I had pulled those numbers out, right? Oh, but that's going to end up being a cash flow out, so we're going to do the negative sign. We did some purchase of long-term investment. We had that there. And if we take a look, we purchased some land, right? Difference between that and that. And I'm just going to find the difference. And because we purchased it, I put the negative sign out in front of the brackets, right? Negative 19,000. We got to take a look through all of our accounts real quick. Was there anything else that was a cash flow from investing activity? I don't see one, so I'm going to go ahead and get rid of these cells. Right? And because we're going to do some math, we're going to put a thick border there. And we're going to go ahead and do equal sum and see if we had net cash provided or used by investing activities. We used more cash than we brought in. Not a big deal, right? It's an investment. Next, we have cash flow from financing activities, right? And we have payment of notes payable that I see, right? And that right there was brought to us by um, the book underneath. I think it was the balance sheet had those little notes. That's where I pulled all this stuff out. So I sit there and I go, okay, we paid that out, equals a negative because we paid it out right there. Right? And then we're looking, and I notice a few things here, right? What do you notice when it comes to um, any kind of proceeds from notes payable? Do you notice anything? Because if we sit there and we go, okay, well, I see about 14,000, right? Difference added in. Well, you also got to take note of the 22,000 that became current as well, right? So we can do the whole thing all over again where we had the beginning amount, ending amount, adding in the current. But right here, we can do proceeds from notes payable. Yeah, those don't need to be bolded, right? And that equals the, and It's going to be a positive because we ended up with more, right? This minus this to get the difference, plus this amount here that we now currently owe, because it got moved from the long-term portion to the current portion. And we got 36,000. Next, we have a payment of cash dividends. Well, they didn't tell us how much it was, right? It just says dividends declared. So we got to take care of it. That's in the financing activities, right? And if you remember how we did this, right? We have our net income, right? And we are going to end up subtracting out the difference between the current total stockholder equity or retained earnings, sorry, and the previous year's retained earnings, right? So minus, oh, I accidentally put in a plus sign there. This minus that. Because that difference right there, the looks to be about $25,000 difference, is what we had after we declared our dividend from our net income. So we notice that we have dividends declared of $7,000, right? And we can go ahead and we can put it over here. Since we paid it out, cash went out, right? So just like that. And it looks like that's about it for that section. So we're going to go ahead and delete some cells. We're going to put a thick border on the bottom so we know that we did some math, right? And we're going to do the net cash provided or used by financing activities. So we're just going to do equals sum. And we ended up with a positive of $7,000. The next bit, we can sit there and go, okay, well, do we have an increase or decrease in cash, right? Well, if we go up here, we do this minus this, it'll tell us one way or the other whether it's a positive or negative. We're all pretty bright. We can see that it was a positive, but it verifies it for us right there. Now, we can take a look at the cash at the beginning of the year, right? And at the end of the year, and that will end up being that difference too. So, cash beginning, right? Go ahead, put a border there, right? And voila. Overall, not bad. Another way of calculating this, right? And if you're doing it in here, it might be the better route. Equal sum right there, and it should match exactly the same thing. Questions, concerns, let me know. This is everything that you can possibly need for this problem, but if I need to explain it any other way, I'll try my best. I think if you use the T accounts, it might make more sense for you. For me, other ways make sense. The whole point is what really resonates with you. There's a lot of ways of doing stuff. Until next time, be good. And if you have any questions, please email or stop by office hours.